My name is Jin Xiao. This is my financial accounting final project. Today, I will talk about what is different between account payable and note payable. What is account payable? In accounting, account payable are debits resulting from purchasing assets or receiving service on credit or on an open account. You have accounts payable when you have not yet paid for the assets or service you have received. In other words, account payable is money owed by a business to its supplier and creditors, and typically shown on its balance sheet as a current liability. The account payable payment process begins as an invoice is received by the purchaser and matched to a packing, receiving slip and purchase order. When the three documents are matched, the invoice is paid. This is referred to as the three-way match. The three-way match can be modified to expedite payments. For example, three-way matching may be limited solely to large value invoice, or the matching is automatically approved if the received quantity is within a certain percentage of the amount authorized in a purchase order. Account payable payment term may include the offer of a cash discount for paying an invoice within a defined number of days. For example, assuming the invoice must be paid within 13 days. If the payment is delayed until day 31, then the full amount of the invoice is due and past due charge may apply. As invoices are paid, the amounts are recorded as reductions to the accounts payable balance in the liability section and cash in the asset section of the balance sheet. Account payable is an important factor in a company's working capital. If it's too high, the company may soon be struggling to find the cash to pay the bills. If it's too low, the company may be unwisely decorating its cash toward paying the bills too soon, rather than enjoying the full grace period and investing that cash in the business instead. The level of accounts payable also affects several important financial performance measures, including working capital, day payable, the current ratio, and others. Next, I want to talk about what a note payable. A note payable is a liability where one party makes an unconditional written promise to pay a specific sum of money to another. A promissory note is a negotiable instrument where one party makes, under specific terms, an unconditional promise in writing to pay a determined sum of money to the other, either at a fixed or determinable future time or on demand by the payee. The terms of a note usually include the principal amount, interest rate, parties involved, date, term of repayment, and date. Sometimes provisions are included concerning the payer's right in the event of a default, which may include foreclosure of the maker's assets. Demand promissory notes are notes that do not carry a specific maturity date, but are due on demand by the lender. Usually, the lender will only give the borrower a few days' notice before the payment is due. For loans between individuals, writing and signing a promissory note are often instrumental for tax and record keeping purposes. Negotiable promissory notes are used extensively in combination with mortgage in the financing of real estate transactions. Notes are also issued along with commercial papers to provide capital to business. When a note is signed and it becomes a binding agreement, a note payable can be recorded to report the debit on the balance sheet. To report the note as a current liability, it should be due within a 12 months longer. The note payable amount can include the principal as well as the interest payment amount due. If period payments are made throughout the term of the note, the payment will reduce the note's payable balance. It's important not to confuse a note with a loan contract, which is a legally distinct document from a note. It is non-negotiable and does not include an unconditional promise to pay clause. Next, I want to talk about what's the difference between account payable and note payable. While both of these are liabilities, notes payable involves a written promissory note, but account payable does not need to write a promissory note. Notes payable usually relate to receiving loans from a bank that will most likely be paid in more than a year, so they will be long-term liability and need to pay interest, and the interest depends on the interest rate. But account payable need to pay in certain days, usually in 30 days, depend on companies required, so they should be short-term liabilities. Account payable refer to liabilities owed to creditors from whom you have made a purchase. Notes payable refer to liability owed to investors from whom you have borrowed money by issuing a debt security. A note payable is a written agreement between a lender and the borrower. Borrowing funds by signing a note payable as an asset to the accounting books of the company. The asset is the actual cash they have received. On the other hand, Signing a note payable also creates a liability on the company's books because they now own the cash and principal back to the lender at some point in the future.